Can you guys believe that it's been nearly 95 years since one of the biggest stock market crashes that later led to the Great Depression? What's going on, guys? It's Ricky with TechBud Solutions. And yes, I am talking about Black Monday. And the really odd thing about Black Monday is that it was October 28th on a Monday, 1929. And if I'm not mistaken, this Monday is going to be October 28th, which is really just odd for it to fall on that. And also, markets are at nearly all-time highs. I'm not saying that the market's going to crash, but again, it never hurts to learn more about what happened in our past for history not to repeat itself. So I really hope that you guys learned something new. And if you do, please consider dropping a thumbs up and subscribing if you feel like we earned it. And very similarly to 1929, the markets were thriving. They called it the post-war rally. For those that are not aware, if we look at the history of this market rally, from 1920, it was the World War I post-rally. From 1920 to 1929, we experienced one of the most aggressive rallies within a short period of time. It was a really nice bull run, right? Went from lows of 100 to nearly 400 and then ended up giving back almost everything from nearly 400 all the way down to sub 100. That sell-off lasted about or nearly 3 years. So the question that I'd like to ask is, well, why did this crash happen? So there were many causes of the 1929 stock market crash, some of which included overinflated shares. Okay, that's right. I kind of call that kind of like the AI boom or the post-pandemic rally where we experienced kind of like this extreme form of inflation, not just in the stock market, but with real estate prices, cost of goods, just everything, right? Growing bank loans. This is also very odd because the really weird thing that happened back in 1929 was that people were actually taking out mortgages or even more equity in their home to actually invest into the stock market. You have to understand, everyone was making money in the stock market, kind of like right now, right? You can throw money at anything, and because markets are so incredibly bullish from 2023 to 2024, it's very challenging to not have made money. And if you look at this, from 1920 to 1929, this is a 9-year rally, and markets are incredibly bullish. So this is why so many average Americans were so incentivized and motivated to become over leveraged. To my understanding, people would take out mortgages. They would only ask for them to really provide at least 10% of whatever they were purchasing in the stock market, and then the rest would be margin. But guess what happens with that, right? If there's any significant pullback, if people or Americans become overly leveraged, then just like we've experienced more commonly on the crypto side of things, when anyone becomes overly leveraged and then there's any form of pullback, you get a margin call, meaning that you have to cover whatever it is that you have potentially lost because you don't actually own those shares outright. And this is where margin becomes very risky, right? So I just wanted you to understand the context of that. There were also agricultural overproduction, panic selling, stocks purchased on margin, which we just talked about, higher interest rates, which of course we are currently experiencing and hopefully working towards lower interest rates as the Federal Reserve begins to cut interest rates, and a negative media industry. Now, I don't think there's anything more negative than what we are currently experiencing, but obviously there's very different variables than what was happening back then to what is happening now. And the great thing about this is that the reason it's not very likely for the same thing to happen 95 years later is Americans learn from their past, right? And I think that's one of the most beautiful things to look back on, is that we see what we've made mistakes in the past before, because no one, not even a mass group of people in any way or any form of perfect, right? So you're able to learn from those mistakes to try to not put yourself in the same overly leveraged position. Now we're $35 trillion in debt for the US debt ceiling, but it's a different type of leverage, I guess, because that's the US and I guess not technically us. So one thing that I quickly wanted to share with you guys is kind of the breakdown of how this all happened. Some people think that this pullback all happened on a Monday, right? On Monday, Black Monday is what they call it, October 28th, 1929, the Dow declined nearly 13%. in one day. So on the following day, Black Tuesday, the market dropped nearly 12%. So you have to think about that. A 25% decline, not in an individual stock. This was for the Dow Jones. This is an overall index, a basket of companies. So if the Dow Jones is selling off, just like if we now experience a sell-off on the S&P 500 or the NASDAQ, then overall individual stocks, the influence that this basket or this index has on individual stocks is also very significant, sometimes maybe even more. Individual stocks might be selling off even more than the actual basket or index of companies. So by mid-November, the Dow Jones lost nearly half of its value. Think about that. By mid-November, it lost another 25%, which then later led to the overall sell-off of from nearly 400 all the way down to sub 100. The thing that I want you to understand about this is that it was actually the week before that the market experienced like an 11% sell-off. I think they called it like Black Thursday. And this was before Black Monday. But supposedly the executives of the biggest banks during that time met together. They brought together a ton of money and began to buy up pretty much the market and show Americans that, hey, there's nothing to worry about. And by the end of Black Thursday, they went from a 11% sell-off or down and in the red to only being down 6%. But think about this. This was just pretty much to artificially support the case that, hey, you have nothing to worry about. Look at me. I'm investing a ton of money into steel and to a bunch of different companies because, again, I believe in these American-based companies. And that did, for a short period of time, kind of bring the markets back into the green. But then, again, there was no question that when people began to understand how overly leveraged they were and what could happen if they do get margin called because they experienced it when the Dow Jones sold off 11% on Thursday, it scared people, right? There was fear in the market, kind of like what we experience now. A really important index to pay attention to is the VIX index. Anytime that the VIX index, known as the volatility index, begins to rise, it shows that there is fear being injected into the market. And when fear begins to rise, or volatility begins to rise, then so does fear. And this is where panic selling comes in. Now, again, if we experience an 11% sell-off in one given day back then in 1929, we could experience a much more aggressive sell-off now because we have the luxury of not needing a broker. Back then, you had to call it in, and sometimes it could take hours. I mean, to my understanding, it was, when people were trying to cut losses or mitigate risk, they wouldn't hear back till maybe 30 minutes later or an hour later. And by that time, markets could have been down an additional 10%. So it is a luxury of being able to execute trades instantly, but you have to think the also cons that come with that. By being able to instantly sell or instantly buy, you can dramatically and instantly cause those stock prices to go down or up within a matter of seconds, right? So the other thing that I wanted to make sure that you guys understand is I think that this kind of puts it into perspective a little bit more in detail from 1920 to 1930, how bullish and how incredible the market seemed to be. The thing that I want you to understand is that supposedly this is, again, when the U.S. was in a post-war production rally. Everyone was incredibly leveraged with these margin positions. And it's kind of like what we experienced in the year 2000 and in the year 2008, where there were simply loans that were taken out that were not good loans, right? And they didn't have good risk tolerance, because if there were any significant pullbacks, then again, people would get margin called, and then that would lead to even more panic selling because they didn't have the necessary capital to actually cover those margin calls, which meant that they had to cover their entire position, which led to even more selling pressure, just like we've seen with crypto. And I keep going back to that, not because I trade that myself, I don't, but because it's, I think, something that if you've ever paid attention to crypto, especially one of the most recent pullbacks that they experience, it was one of those main reasons where a lot of crypto trading platforms went under, is because they were incredibly leveraged. And when crypto began to crash, they didn't have the necessary capital to cover those positions. And I think that is a very important thing to pay attention to, is that there's nothing wrong with having a position in the market as markets are incredibly bullish, but it's just making sure that you could actually tolerate the time that the market might take if we do experience a sell-off and then markets end up recovering. And one of the last things that I want to share with you is that, well, you have to understand that some people don't view that this was the main reason on what later led to the Great Depression, because again, that didn't happen until necessarily years later. But you have to understand this supported the case that yes, there was weakness in the market. People were incredibly leveraged and markets were incredibly inflated. And because of how much money was lost during this time, led to people not being able to financially recover for years after. So some people don't view it as the spark. Other people view it as the sole reason of what led to that Great Depression. But all I can say is, again, do not put yourself in a position in which you cannot tolerate. I don't think that individuals or even investors should ever be scared to invest in companies, but just make sure that you do it with a dollar amount in which you can tolerate in a tasteful way, right? And one thing that I do want to share with you is the only thing that kind of does bring some concern is the live updates that we are currently getting about the Israel attacks in Iran. So as of right now, according to what Biden is saying, is Biden reacts to Israel strikes on Iran. My hope is that this is the end. I think when any president relies on hope, we are put in a very uncomfortable position where we are given other countries pretty much the luxury to do whatever it is that they want to do. And we just hope and sit back and hope things begin to clear up. But based off of history, that never seems to be the case. So if this continues to escalate, if this continues to get worse, pay attention to the VIX index, because if volatility continues to get instilled into the market, then again, when volatility begins to rise, when the VIX index begins to rise, you will see that markets naturally begin to drop because there is uncertainty. And especially as markets are at all-time highs, and also, big tech is supposed to report earnings next week, such as Amazon, Google, Microsoft, Meta are all reporting earnings next week. It is going to be a very crucial time that can send the markets to new all-time highs, but also if their guidance comes in lower than what was expected, could correct the markets for a short period of time. And the last thing that I want to share with you is that even with how bad Black Monday was, and even the years after of how terrible it looked, the US has always recovered. Remember to never put yourself in a position that you simply cannot tolerate. The biggest mistake, if you look back in every single type of crash, is people became incredibly leveraged. And yes, you can make a ton of money when you can borrow against your money and put even more capital during bull markets. But when markets are incredibly overbought and exaggerated and overinflated, then you need to make sure that you could tolerate those pullbacks. And if you can't, and there's thousands, if not millions of people that are in the same position, then that is where the panic selling kicks in. So again, just wanted to make sure that in celebration of this anniversary of nearly 95 years since Black Monday, we would make this video, and I wanted to hear your guys' feedback on how you feel about the market. Do you think that the US is in a great position? Do you think that we're set for new all-time highs? Or do you think that the markets are incredibly inflated and preparing for some form of correction? Nonetheless, again, my job here is just to cover the markets on a daily basis. I do trade live every single day, and it's designed for complete beginners. If you ever want to tune on in, it's the second link in the description down below if you want to learn more. I appreciate your time. I hope that earned your thumbs up. Please consider subscribing. And like always, let's make sure that we end the year on a green note. Take care, team.